Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures trying to stage a rebound this morning after the S&P 500 closed in the red for the fourth consecutive trading session. The stock sell-off led by mega-cap tech names, with the Magnificent Seven cohort officially falling into correction territory, while sectors like consumer staples outperformed.
But the big focus today is Nvidia. The AI chip giant's earnings have become one of the most important events for Wall Street, and its latest results may actually be the most critical yet. Options indicating that the results could fuel a move in the stock of up to 8.5% in either direction. Now, the earnings report coming after DeepSeek scrambled some of the outlook for AI infrastructure. This is also the first time since 2022 that Nvidia will report earnings with shares down since its last report.
And odds of tax cuts are rising. House Republicans passed a budget blueprint calling for deep cuts in safety net programs such as Medicaid, paving the way for $4.5 trillion in tax cuts. The budget blueprint is the first step in a process that allows Republicans to bypass Senate Democrats on legislation related to taxes and spending. But its passage does not guarantee an extension of the expiring 2017 Trump tax cuts. The measure was passed with a 217 to 215 vote, with only one Republican opposing and all Democrats present voting against it.
U.S. stock futures are pushing higher this morning after the S&P closed in the red for the fourth trading day in a row. Of course, we take a look at some of that risk-off sentiment that has swept the markets. We are looking at some buying action here ahead of the open. You do have all three of the major averages on track to open the day in the green. Of course, the big focus today is going to be Nvidia's results. It's going to be driving much of the sentiment that we are going to be getting. It's going to be a little bit of a break from some of the worry that we have seen creep into the broader markets here surrounding U.S. growth and what exactly that means following a string of some of that weaker than expected economic sentiment numbers that we've gotten out over the last several trading days. So again, going into this report on Nvidia, a lot riding on this. Obviously, the implications here for the broader market. And Brad, you mentioned it, or we mentioned it there at the top, the fact that this is the first report since 2022 that Nvidia is reporting results and shares are actually down since its previous earnings report. So again, just a lot riding on this, whether or not they are going to be able to maybe regain some of that lost momentum.
Yeah, you mentioned it. I can't take credit for that one, but
yeah.
all these things considered,
we mentioned it.
It's going to be a massive report. Yes, exactly. Here, it's Team Smith here this morning on Morning Brief and every day. But one of the major areas that we've seen within this sell-off kind of catch the eye of some of the larger institutions out there and money managers is where else globally they're seeing some appetite for equities here. And European stocks, BlackRock was calling that out early on in this week. They still think that U.S. equities can outperform in 2025, led by tech, even as Europe's start to the year was strong here. But they're broadening their risk-on view, and many of the firms similar to BlackRock kind of upgrading their Europe stocks outlook. But it does come back to Nvidia, and not just what Nvidia is saying about demand right now, but also more broadly internationally. And that's where we could get even more of that correlation between how some of the other firms are looking at the global picture and what's taking place through the eyes of Nvidia. And speaking of the aforementioned Nvidia, NVDA shares right now up pre-market ahead of its results after the close today. The stock is expected to move 8.5% in either direction following the results, according to Options AI data. Now here with the street and their expectations from the earnings report, we've got tech editor Dan Howley here. Dan, what do we know?
Yeah, Brad, this is going to be obviously a massive report for NVIDIA. This is something that I think the entire tech industry is trying to just prepare for, whether or not they beat, whether or not they beat and raise. Guidance has been very important for NVIDIA stock over the last couple of quarters. And I think, let's just look at what the numbers expectations are real quick. We're looking at adjusted EPS of 84 cents. That would be a 63% increase year over year on EPS, and then revenue of $38.2 billion. That would be up 73% year over year. I want to point out real quickly, when you've looked at how the stock has performed just immediately afterwards, it's tend to drifted downwards just on I think how people are responding to the year-over-year growth numbers, because we're coming off massive year-over-year growth. So the comp is not necessarily in NVIDIA's favor. And so if we look at the last year, Q4 last year. Their EPS was up 486%, and their revenue was up 256%. So it makes that 63 and 73% look pretty paltry in comparison, though I'm sure any other company would kill for that. But what we're really going to be looking at is any kind of commentary we can get around guidance. As I said, that's been a big kind of indicator for NVIDIA, as well as push in the direction of the stock. That could also start to move the likes of Microsoft, Google, as well as other chip makers, AMD. The other that we want to talk about is cloud segment. In the CFO commentary from Colette Kress, she mentions how much of their revenue, their data center revenue, is coming from cloud companies. So those are the Microsofts, the Amazons, the Googles, the Metas, what have you. Last quarter, that was 50%. There's been talk, murmurs of Microsoft maybe moving some of its spending around, although they've all said that they're going to push spending well into the tens of billions, and in Amazon's case, $100 billion this year for AI. So we shouldn't see too much difference there, although you have to wonder, these companies are trying to develop their own chips. They're leaning on other companies. They want to ensure that they're not beholden to Nvidia. So as that kind of matures over time, what does that then mean for Nvidia's cloud growth as far as the revenue from those providers? And then on tariffs and export controls, this has been something that's been just at the back of everyone's minds, I think. The tariffs, obviously, Trump's discussed 25% tariff on chips. And then the export controls, there's been talk about pushing harder export controls on those H20 chips that DeepSeek used to prepare its own AI models. And that kind of sent the entire AI trade into an uproar when that was announced. So those are really the main things that I think we're looking at just overall. And I think when it comes to this company in and of itself, it obviously is the bellwether for the AI trade, and it's going to potentially move around the other big tech giants as well, just because they're so embedded in AI at this point.
Yeah, we certainly have seen that in the options pricing, at least just in terms of the direct moves that we could see right after. Hallie, great stuff. You got a busy day ahead of you.
Oh, yeah.
I'm going to let you go prepare even more. All right, Hallie, thanks. Let's stick with Nvidia because it is the closely watched results, and this comes amid DeepSeek-fueled AI spend skepticism and chip export control concerns. Those fears have pressured tech stocks in recent weeks. Now, heading into this report, Nvidia shares are down nearly 6% just over the last 5 sessions. Joining us now on what to expect, we want to bring in James Achokmak. He is the Chief Investment Officer of Clockwise Capital. James, it's great to have you back here on Yahoo Finance. So what do you think of that we are going to hear from tonight's report? And just put it in perspective for us, just how important this report is for the broader market.
Yeah, sure. Good morning. It's very important, as you guys outlined. Here's the good news. The good news is that you're probably going to have a nice beat on revenue and a nice upside to the Q1 numbers. By our estimate, about 5% on both. So, you're going to have a very solid result. The question is, the bad news is that a lot of people already are pricing that in. And then you have some questions around the gross margin. I think that, you could be in a situation where the reaction to Nvidia could bifurcate from the reaction to the broader market. So long as you're seeing the revenue continuing to grow at that healthy clip, that should instill confidence in the broader markets that the trend is still going in the right direction, despite the expectations not being excessively surpassed based off of the current consensus numbers.
Pre-market move higher here. Year to date, stocks down 8%, though. Is this a buy signal?
No, not until we get the numbers. I mean, from our standpoint, we were trimming the stock in the 140s. Right now, it's about 8% of the benchmark. We're about half of that as it stands right now. There is a lot of risk. You can't sugarcoat it. But the good news is that expectations have come down significantly over the last 2 weeks or so. So, the setup, we think is incrementally starting to skew a little bit positive, but not positive enough where you want to, you want to bet the farm on it.
When expectations get lowered for Nvidia, what type of warning sign or red flag is that even for the rest of the semiconductor landscape?
Yeah, it's a warning sign for sure. But the good news is that we have a lot of the customers of Nvidia coming out with very high guidance on the capex side. From Microsoft, Amazon, Meta, They all upped their CapEx guidance numbers for 2025. And so the spend is still certainly there. In our view, that spend could come down over the course of the year, lower than the bars that they had set, which is why, you got to be careful with the chip makers. We personally at Clockwise are increasingly putting our assets into names like TSM, ASML, over a name like Nvidia, because we think that the demand is sufficiently there while you have a lower bar in terms of expectations.
James, what is the upside then, or what does the opportunity look like then in those names? And I guess for investors out there trying to evaluate whether or not it is still an attractive time to buy Nvidia, obviously tonight's results are going to give us a little bit of clarity, but what would give them that green light signal?
Yeah, I think you got to have revenue beat in excess of 5%. If that's the case, the numbers will come up across the board. You can extrapolate that earnings power. I think that should, if it's in excess of that, I think you're going to have another bull run in the market here. We're not sure if that's going to be the case, which is why we're slightly more cautious. But even if they met those expectations, that could be decent for the broader markets. That demand isn't falling; it's just not growing in excess of what by the margin and degree that they've been beating in the past.
James, thanks for taking the time here with us pre-market. We're going to continue to track these moves even after the results drop. Appreciate it.
Sure. Thank you.
House Republicans' President Trump-backed budget bill narrowly passes with a slim 217 to 215 margin, paving the way for sweeping spending cuts and $4.5 trillion in tax cuts. Our very own Rick Newman joins us now on this. Rick, your analysis of this entire bill that made its way through.
It's a first step. So those numbers that you just showed, those are the baselines. It doesn't say what the tax extensions or tax cuts will be, and it doesn't say what the spending cuts will be, and that's going to be the hard part. So just to go back to it, Brad, you said that you just showed $2 trillion in spending cuts that are going to have to be part of this bill. So that is over 10 years, so call it $200 billion per year. That's hard. It's hard to cut that much spending, and there are not a lot of places you can do that. So in order to finance the extension of these tax cuts and some new tax cuts, it's looking like there are almost certainly going to have to be sizable cuts in Medicaid. That's the health program for the poor, and then also in perhaps things like Pell Grants or food benefits also for the poor. That's just where the money is. And that's assuming that there are not going to be any cuts in Medicare or Social Security. So this is the House's version. The Senate has a different version. There's still a long way to go to get actual legislation that President Trump might be able to sign. And it's still not clear whether Republicans in the House and the Senate will agree on what those spending cuts should be. So that's going to be the drama on Capitol Hill for the rest of 2025.
And Rick, on the geopolitical side, we're also getting some news developments here. Most recently, the Ukrainian government confirming a drafted agreement with the U.S. for the country's rare earth minerals, and this would come in exchange for security guarantees. What can you tell us there and the steps forward that this could potentially see here for ending Russia's invasion?
I don't think it's going to end the invasion. I'm not sure anything is going to end Russia's invasion. We should all be very skeptical of talk that Russia somehow will agree to just stop the war they started 3 years ago. This deal on minerals is really interesting. I mean, it looks like Ukraine, led by Vladimir Zelensky, the president, is like learning how to speak Trump's language. Trump wants a deal. They're like, okay, we'll make a deal with you. I think there are major questions about what this deal would actually be, assuming it is going to be a real deal, so that the United States gets access to whatever Ukraine might have, lithium, titanium, that's the kind of stuff we're talking about. What does that mean? Does that mean the U.S. government has those rights? Does that mean the U.S. government secures those rights on behalf of American companies? How does that work exactly? I mean, a lot of unanswered questions. But, Zelensky is pretty crafty. And I think I love the fact that he's just like, okay, Trump is a deal maker. He wants to be able to say he made a deal. I'll give him a deal. Whether there's any substance to this deal remains to be seen. But Ukraine and Zelensky are hanging on for now.
All right, we will see. And he's expected to travel potentially to Washington on Friday too, right?
Yep.
All right, Rick, great stuff. Thanks so much.
Hi, guys.
Well, coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, Super Micro shares, they are surging after reporting its delayed financials. We got those details ahead. You're looking at gains of 20%. Plus, full coverage, of course, of Nvidia as Wall Street awaits the most critical earnings report here, potentially, of the earnings season. We've got all that for you coming up ahead on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Super Micro Computer reporting its long-awaited financial results just ahead of the Nasdaq's delisting deadline. The AI server maker had delayed filing in August after a report from short seller Hindenburg Research alleged accounting red flags. Nasdaq granted the company an extension after its former auditor, Ernst & Young, resigned in October here. There you're taking a look at shares which have largely been moving just on the deadlines that they've been trying to kick the can and essentially have been able to successfully kick the can down the road. And now, finally, we get some evidence coming forward of how much they actually made during the quarter that was in question here. And it seems like for the results that now have a new auditor that they are working with, they are back in compliance here. The company essentially saying that they were able to meet this deadline. And now we have finally a look at some of their assets, which sit at about 10.8, what looks like $10.8 billion at this juncture. But more largely going forward from now, I think the question is about what their customers think about doing business with them as well and how they continue to retain those customers as well.
Yeah, I think this offers a bit of relief. I think there's more remedies, obviously, that are necessary. That was one of the things that were highlighted in this report. And of course, when you take a look at the quick reaction that we are getting from the street, there's lots of questions that do remain unanswered when it comes to some of those financial controls. Obviously, we are seeing some improvement there, but what exactly that steady improvement could potentially look like here in the weeks, months, quarters here to come. So leaving it open, I think, to some risk out there right now. And I think that very much you can see still reflected in the stock price, even though we are looking at shares up just about 19% today. We're still a far cry from where they were just about a year ago here. And so we are seeing a bit of a relief. Very much this was expected, I think, if they were to file, obviously, by yesterday's deadline. But you can see over the 1 year, the stock's still off just about 47% and wasn't just shy of 120 just about less than a year ago there last March. So again, it's going to take a lot to get back to that momentum. Obviously, when you take a look at the macro picture, AI demand, the fundamental part of the story, that looks strong here. But I think when you break down exactly what it looks like under the hood at Super Micro, there are still some questions that need to be answered for investors.
Yeah, the company had been delisted before. Hindenburg had put this in their report. In 2018, the company had been delisted from NASDAQ for failing to file financial statements. You fast forward into what they had to work through in 2024. And here and now, as Luther Vandross would say, finally being able to file these results that ultimately revealed that revenues came in, or at least net sales for the most recent reporting period that they were publishing for, were at about $5.9 billion for the period, just shy of $6 billion for the period there.
All right, let's take a look at Lowe's. It's another mover that we are tracking here at Yahoo Finance. Lowe's topping fourth quarter expectations, same-store sales are rising for the first time in just about 2 years. Still, though, the home improvement retailer's outlook coming up just a bit short. They talk about some of the uncertainty that they face in the near term. Now, this is a bit similar to some of the sentiment that we heard from rival Home Depot earlier this week. You are, though, looking at gains of just about 4.5%. So the fact that same-store sales growth did turn positive, it's helping some of that sentiment there on the street. Lowe's annual guidance slightly trailing consensus expectations, and this was similar to what we heard from some of the reaction to Home Depot as well, much of the street is looking at that guidance as being conservative. So they think that they are going to be able to beat it. There was a couple of analyst notes out there calling it prudent as well. So similar to Home Depot, similar to what we heard from Walmart, maybe there is this thought out there from the street, this confidence that they are going to be able to exceed some of that weaker than expected guidance. And that, of course, will be adding a bit of a lift here this morning.
Yeah, three things that were called out within this report: pro and online comparable sales, strong holiday performance, and then some of the rebuilding efforts in the wake of recent hurricanes. However, what was offsetting all of what they categorized as some of the areas of strength in the quarter, continued near-term pressure in DIY, do-it-yourself discretionary spending. That is something that we also heard from Home Depot here. And so going forward, as we're thinking about what these results mean, even though they were better than expected, as Marvin Ellison, CEO and chairman and and president of Lowe's, that said within this release they are continuing to gain some traction with this total home strategic initiative that they had unveiled to the street, and ultimately seems like they're pretty confident in the strategy, capitalizing on some of the expected recovery that they're anticipating to come forward here. You're looking at a comparison here, extended hours of how Home Depot and Lowe's are doing. Lowe's, of course, moving higher on those fresh results. Home Depot, even though we did see a little bit of a different reaction yesterday, perhaps bouncing back just a little from their results. Finally here, let's talk Lemonade. Lemonade falling today after missing fourth quarter revenue estimates. The online insurance company also issuing weaker than expected guidance for 2025, expecting to take a hit from losses related to the California wildfires. Joining us now, we've got Daniel Schreiber, who is the Lemonade CEO. Daniel, always a pleasure to grab some time with you here, and thanks so much for joining us. Walk us through these results and how you're looking at 2025.
Absolutely. And it's interesting that you framed it as a miss on Q4. I think it's been taken as a comfortable exceed on Q4 by just about everybody. We'll talk about guidance in a second, but this was by far and away and by any measure pretty much the best quarter for the company ever. So fifth consecutive quarter of accelerating growth. We saw 2x or 100% growth in our gross profit year on year. Our expense line remained flat pretty much, or even negative in real terms. So we saw tremendous AI efficiencies kicking in, all of which resulted in $48 million of positive free cash flow, which came in. We weren't expecting 2024 to be cash flow positive. We were expecting that to be next year. It came in about a year ahead of time. So I think top line, expense lines, gross profit, bottom line cash flow, everything came in ahead of our own expectations, let alone the streets. Guiding for 2025, we think we're going to do exactly what we have continuously said, which is continue to see acceleration in 2025 towards 30-something% next year. So we guided to continued acceleration. We guided to consecutive EBITDA improvement towards EBITDA break even and profitability towards the end of next year. So from our perspective, this is entirely in line with what we've said we were going to do all along. So we're feeling pretty good, excellent about the results, and pretty good about the path ahead.
Daniel, when it comes to the California wildfires, something that was discussed a couple of times here on the earnings call that you just wrapped up earlier this morning, I'm curious what that overhang looks like for your business.
Yeah, so obviously the California wildfires were devastating for the communities in Los Angeles, and that includes many, many of our customers. We saw approximately or approaching 1,000 of our customers suffer during the fires. So we've been very busy tending to their claims as best we can. And turns out that the best we can is pretty good. We were able to settle hundreds of claims within the hour of them being submitted, oftentimes while the fires were still raging. We monitor customer satisfaction pretty closely, and at a delicate and sensitive and difficult time like these fires, being there for customers, reassuring them that even if their home has gone, at least the insurance company is going to pay up in full and instantly is hugely important. And if you look at the customer satisfaction scores, the CSAT out of 5, we scored 4.98 with a 91% NPS, which is really off the chart. So we've certainly stood the test of were we there for our customers. In terms of the financial impact, there were estimates that Lemonade would have to pay out as much as $200 million just looking at our market share. In fact, we are going to be incurring something like $45 million of gross losses. And because we have pretty sophisticated and conservative reinsurance structures, the ultimate impact on our EBITDA this year and in Q1 will be as modest as $20 million. So our people, our systems, and our financial structures were all tested by these devastating cataclysmic events. And I think they were all true to the moment.
Daniel, how much of that increased efficiency that you were talking about is driven specifically by AI? And if so, then how much more investment maybe are you thinking about allocating to that to further improve your business?
It's overwhelmingly about AI. We saw 100% growth in our revenue over the course of the last couple of years with 10% decline in our headcount. So we're doing a lot more, servicing many, many more customers, selling more products in more geographies, and doing it with fewer people. We're not doing it with less intelligence at work. We're doing it just with less human intelligence at work. And each of our customer support agents and each of our claims agents and each of our engineering programmers, et cetera, they are all managing to output far, far more than once they could. Almost all our policies are sold entirely by AI, something like 98% without human intervention. And that is also true of the majority of our claims, which are settled without a human ever needing to be in the loop. So you crush costs through the use of AI while delighting consumers who get instant everything without any kind of nonsense that they associate with insurance typically. We think there's a lot still to be done as LLMs and other models continue to progress. The challenges that once, and when I say once, 6 months ago seemed insurmountable to them, are becoming easy for LLMs to handle. You can start moving from app interfaces to email interfaces, SMS, and we've already started showing some of the voice interfaces that we're doing. So we think that that trend has a lot of legs and will run for quite a while.
Daniel Schreiber, CEO of LMND, thanks so much for taking the time to join us.
Good to be with you.
Let's take a look at Instacart under pressure after reporting mixed fourth quarter results, issuing a weaker than expected outlook for the first quarter. That's weighing on shares today with the stock off just about 10% ahead of the open. We'll be right back.
Taking a live look at the opening bell at the NASDAQ, where Control Group is ringing the opening bell. Music make you lose control. And they got some funfetti on the right side. And on the left side of your screen, you've got NYSE's shot of the New York City Department of Veterans Services ringing the opening bell to kick off today's trading activity. Let's take a look at where we begin. The Dow Jones Industrial Average opens up flat, but to the upside here, 0.2% fractional gains here on the day out of the gate. S&P 500, you're seeing that up fractionally as well by about 0.3% here. I want to populate this chart for you just so you could see how things are moving on this hump day, coming off of some of the other activity that we've seen to start off this week here. And you can see some slippage over the past 3 sessions here for the S&P 500. We'll see if we can dig out of that here and now. And taking a look at the NASDAQ Composite, that begins things today higher by about 0.4%. Let me populate this chart for you as well. If it will cooperate, we will be able to show you the past 4 days, and we are. It's down by about 4.3% for the tech-heavy NASDAQ. We're going to dig into XLK for a hot second here as we take a look at the S&P 500 sector activity out at the gate this morning. We've got more gainers than laggards here, but as I mentioned, XLK, that is leading the pack. That's up by about 0.9% here. And lastly, taking a look at the NASDAQ 100, you've got Nvidia leading the pack, going ahead of its earnings that are coming later today. Opens up the day by about 3.5% to the upside. Let's get to Yahoo Finance's Jared Blickery for a deeper dive at what's looking here early in today's tape. Hey, Jared.
Thank you, Brad. Well, I want to start off with the S&P, well, actually the Russell 2000. The Russell 2000 has been acting pretty weak. It just closed at the lowest price since September. I'll put a 6-month chart here so you can see there, it just barely undercut these lows. And if you're squinting, you can kind of see a head and shoulders top here. So definitely want to get back above this line here. Let's call it 2180. And we want to see that in ideally today or the next day. So that Russell 2000 looking a little bit weak there. S&P 500 has been weak this week, as Brad was just going at, but the S&P 500 equal weight has been surging, and so it's a different chart. You take a look at the S&P 500 equal weight this year, much stronger. So what we've been seeing is this bifurcation in the market where tech, and especially large tech, has had some bumps this year and in the month of February, and that's what we're dealing with here. And the big question for traders is, how does the bull market stay alive? Do we have enough rotation in some of the other sectors to keep everything buoyed? And so far we have, but we're in danger with several of the indices, several of the sectors undercutting some big technical levels. Here's a 10-year T-note yield. So it just touched the lowest since December, but it's not doing anything right now. It's a big flat, so we'll keep an eye on that, but not doing too much today. And I want to skip over to the sector action. As we close the month of February, I've been noticing, and I'm going to put a 1-month trailing chart here, so that'll get a few days in January, but this illustrates the point. Consumer staples, that's the stuff that we need. That is up 7%. That is leading this month, and that's a defensive sector, so that's not necessarily bullish. Consumer discretionary, the stuff we want, that is leading, but to the downside. So that's Tesla, that's Amazon. Both of those have been faltering recently, and Tesla has been hurting this year. So let's take a look at what's going on today. Just one more time, tech leading, staples lagging. So a little bit of a reversal from fortune from the beginning of the week. And we'll switch over to the NASDAQ. And I wanted to take briefly a look at Tesla, which is having a rough go at it this month and this year. As I was stating, it's actually the worst month for Tesla since January of last year. Here's a year-to-date chart. You can see it's shed about 1/4 of its value there. And from here, we're going to finish with the futures market. A few interesting things happened yesterday. We saw some big declines in a bunch of different markets. Crude oil and gold have caught my eye. Now, gold has been rallying fast and furious towards 3,000, never quite got there, but it has fallen back to 2,900. In case you're worried about the long-term trend, it is still intact there. So gold bugs still have that 3,000 in sights in potentially the near future. We'll have to see how that plays out. And finally, WTI crude futures. Those had a big down day yesterday. And last I checked, they were holding about $68, $69 per barrel. See if we can get a quote there. There we go, 68.89. So crude oil, another market we're watching, and see if that stays under pressure. But with all the inflation talk, with all the inflation gauges heading higher, one has to wonder when it reverses to the upside. Seana.
All right, we're going to talk to Ines in a little bit more about that. All right, Jared, thanks so much. So now for today's strategy session, retail investors' favorite trade has come under a bit of pressure with the Mag 7 cohort officially entering correction territory. But investors who have actively managed their portfolios to move out of tech stocks have actually outperformed the S&P 500. You can see it up there on your screen. Joining us now, we want to bring in Angelo Krokafis. He is Edward Jones, a senior investment strategist. Angelo, when you take a look at the underperformance here of the Mag 7, so those investors, I guess, that have favored actively managed funds have been able to maybe avoid some of those losses. But I think the big question for investors right now is whether or not the trends that we've seen since the start of the year, are they going to continue or if they are going to reverse on the heels of what we hear tonight? What do you think?
Yeah, I think the broadening of market leadership that we have seen, and it is encouraging for those with well-diversified portfolios, has some legs to that. There is a potential for that to continue. And I think it speaks to the resilience of the market that even with the Magnificent Seven lagging the S&P, we still have a market that is up for the year. And we thought all along that earnings will have to do the heavy lifting, not valuations, and that so far is proving to be the case. Investors can diversify and actually find areas that have this catch-up potential, even without relying only on the AI trade, which is still an important one.
So if we are seeing that diversification take place, that would also suggest perhaps that more than just a sell-off, this is a great perhaps rotation that we're seeing play out. Where's that rotation into from what you're evaluating?
Yeah, so it's a rotation at multiple levels. It's been across sectors, investment styles, thinking about value versus growth, and also geographic. Europe is hitting European equities, all-time highs. Asian and Chinese equities are participating as well. So thinking about the policy mix, there is some uncertainty with tariffs, there is some excitement about tax cuts. And when you put everything together, we still think that US equity markets are well positioned in terms of some of the domestic cyclical areas can stand to benefit from these tax cuts, while growth, yes, it is modestly slowing, but remains pretty robust in the US.
How worried are you about the slowing U.S. growth in the U.S. and ultimately the cap that could put on equities this year?
Yeah, I think it might be a first half, second half situation where we do experience a soft patch in the first half. We did see some weakness in retail sales. The PMIs for services activity have been a little weak, and the economic surprise index is back to negative territory for the first time since May of last year. So all that suggests that we could see a seasonally weak first quarter, and that has been a pattern over the last couple of years, but then a reacceleration later on. The fact that we are slowing from a strong starting point is not as worrisome as even 2% growth for the standard of an advanced and very large US economy that can still provide a solid foundation for corporate profits to continue to rise. And that's what we've seen.
Wasn't it just yesterday that the Fed Vice Chair for Supervision, Michael Barr, was saying that the growth for the economy still relies on policy stability, and maybe I'm getting that mixed up, maybe the policy relying on economic stability, but you have things that could throw off that economic stability right now, both in the form of employment and inflation driven from any tariff impacts as well.
Yeah, no doubt there is a lot of sensitivity to what's going to happen on the inflation front. Some upside risks, no doubt. So far, we have seen some rise in inflation expectations, and that's what the Federal Reserve pays close attention to. But at the same time, they're comfortable keeping rates where they are. There's no urgency for them to cut. And looking at the labor market, it remains pretty steady. We've seen 21 months of continued wage gains exceeding the rate of inflation, and productivity has been rising, and that's a positive story. We can still have robust wage growth without refueling inflation, especially for services. Which is what is the category that's still pretty elevated.
And so how are you looking at the outperformance that we've seen overseas, particularly in Europe, and maybe what that tells us?
Yeah, it is encouraging the fact that many people have left European equities for dead. Whenever the pendulum is swinging too far one way, it kind of self-corrects, and that's the phase we are in now. There is some hopes of Russia-Ukraine peace agreement, which could result in low energy prices. Still too early to make that call, but the fact that European and some of the other international markets were so discounted, that provided this release valve as a lot of pessimism was baked in. That said, over the last 10 years, we've seen several counter-trend rallies. So it might be a little premature to say that this is the start, the beginning of something larger. But for those investors that have been way too underweight international equities, it's a good reminder that they deserve a spot in portfolios, especially as we deal with very different scenarios on how things can play out on the trade front. If things are not as onerous or aggressive as feared, that can be a catalyst, a trigger for a continued rally, but too early to make that call.
It's a great reminder. Angelo, thanks so much for taking the time here today, just after the market open.
Thank you.
Appreciate it. It's time now for our charts of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at Nvidia and where the street expects shares to head. Maddie.
That's right, Brad. Nvidia price targets from analysts on Wall Street starting to outpace the performance of the stock. So let's take a look at this. Analysts continue to boost Nvidia's price target, and now the best price targets, the highest price targets on the street, are significantly outpacing the performance of the actual stock by the biggest difference since earlier this year. And you can see here this divergence really starting up following the $600 billion sell-off we saw in Nvidia's stock after DeepSeek poured out this idea that they were able to train their AI for cheaper. Now, what's really interesting about this is, of course, as a potential shareholder, you want to own the stock at a time when the stock is potentially outpacing those analyst price targets. But one of my favorite sources to talk to about this, Steve Zhao over at Bloomberg Intelligence, basically did his PhD in analyst price targets and taught me a lot about it. And he has said that over time, analysts tend to be correct. So yes, right now, analyst price targets are a little bit above Nvidia's share price, meaning that they could be wrong. They could be overly bullish on the stock. But if you look at the totality of analyst price targets on stocks over time, they do tend to be right. So that could be one potential indicator that Nvidia's stock price could be hitting these analyst best target prices over time. Of course, tonight's earnings will give us a great indication of that. We will all be monitoring any news to come from the man in the leather jacket later today.
We certainly will. All right, Maddie, thanks so much. As we head to break, let's head to check on shares of TJX, the company behind TJ Maxx, Marshalls, and Home Goods. Easily beat Wall Street expectations for its holiday quarter, but it issued a guidance that came in just below the street's expectations. It looks like the street, though, very much focused on the fact that it did surpass when it comes to some of those sales estimates there for the street. Again, enough to look at gains here in early trading. You look at the stock up just over 1%. We'll be right back. Bitcoin trading right above 86,000, remaining below 90,000 mark for the second day in a row. Now, when it comes to the most recent declines, we're seeing Bitcoin trade at levels that we haven't seen since November. When you take a look at that pullback that we've seen over the last couple of trading days, now this follows the rally that we saw following the inauguration of President Donald Trump, also some of the excitement following his election back in November, which sent the prices to record highs. Here with more on what we could expect going forward, we want to bring in Scott Melker. He's the host of the Wolf of All Streets podcast. Scott, it's great to have you back here on Yahoo Finance. So help us make sense of some of that selling action that we have seen in Bitcoin most recently.
Well, I think that there are a few catalysts for the selling. First, obviously, as you mentioned, we overshot probably the high end on hype around Trump hitting a high of around 109,000. I think the market is now absorbing most of that and finding a mean reversion of sorts. But I think there's a few catalysts that have been sending price down at the moment. Obviously, there's just macro fears in general of tariffs, of instability. Markets hate uncertainty, and I think we're seeing that to some degree with Bitcoin and the crypto market as a whole. We had the Bybit hack of roughly $1.5 billion in Ethereum by the Lazarus Group in North Korea. I think most of Wall Street and institutional investors didn't know about that until they woke up on Monday. That's probably contributed to the sell-off. And then, of course, the absolute meme coin madness with Trump launching a coin and then the Libra token debacle in Argentina. We've just had some short-term catalysts for downside that I think will be relatively quickly absorbed, and then we can get back to the bull market that we're used to.
To what extent do you believe that there is still trust that needs to be reinstilled coming off of some of the other meme coin events that have taken place, even from the voice that said that they were going to be the pro-crypto president and that we've got a Bitcoin strategic reserve that's going to be prioritized day one?
Well, you have to remember that those things were effectively priced in as promises. So now you need to see Trump and his team deliver on them. And I think that largely we have. There's just really high expectations. We have a pro-Bitcoiner in almost every cabinet position that exists in the White House. We have pro-Bitcoiners at the SEC, CFTC, literally across the board. So those promises are being made. And we do have legislation on the books for that strategic Bitcoin reserve. I think the meme coin craze will be forgotten. I think it's also important to remember Libra, technically not even a meme coin at all, literally just a pump and dump by a government or the leader of a government, but it was promising specific utility to help businesses in Argentina, very different than meme coins, which are literally described as having no utility as collectibles. But I don't think that there's a huge amount of trust that needs to be gained back. I think those things, as I said, will just disappear into the ether. They're just a nonsensical sideshow to the game. Everybody understands now that Bitcoin itself and crypto are here to stay. They're serious institutional assets. When you have Citadel talking about coming in to become a market maker, I think that a few meme coins will be forgotten.
Scott, when it comes to certainly, obviously, the street, Wall Street and Main Street very much showing more interest within crypto, I'm curious, when you take a look just at the fact that volatility swings, and you can obviously make this argument for many investment vehicles out there, but what does that do? Does that at all, do you think, keep some investors on the sideline, just given how rapid of a run-up we had following the election, peaking right around the inauguration? Now we've been selling off just a bit. I guess, how should investors then be looking at when is the right opportunity to buy?
I don't think that investors should be trying to time the market or find the right opportunity because, as you said, it is volatile. That may keep some people on the sidelines, but I think that that number is drastically reduced. And listen, I mean, volatility is the price of admission for exponential gains in Bitcoin, and it's not really that different if you buy at 86 or you buy at 80 or you buy at 75 if you believe it's going into the multiple hundred thousands or millions with time. The best strategy is to go full Michael Saylor and dollar cost average slowly into Bitcoin when you have money that you're willing to invest and not touch for a long time. So I would urge people not to really be concerned with whether the price is 86 or 82 or 90, because long term that will effectively be a nothing burger. I mean, I would argue that Bitcoin hasn't crashed. It's on sale. And we know that smart money buys the blood, even if it's their own. And that's what's happening right now. You can see that there's some retail exiting, but institutions are gobbling up Bitcoin at an unprecedented pace.
Scott, thank you. We're continuing to track all the moves here this morning. Appreciate it.
Thank you.
Before we head to break, let's take a look at shares of General Motors. GM raising its quarterly dividend by 25%. The company also announcing $6 billion in stock buybacks. Shares higher by 7% right now. British oil giant BP announcing it's pivoting its focus back to its core oil and gas business while lowering spending on renewables. Here with the story, we've got Yahoo Finance senior markets reporter Inez Ferre. Inez, what do we know here?
So I spoke to CFO Kate Thompson this morning, and three of the main points that the company wants to make is one, reallocating investments, going more towards oil and gas and less towards renewables, reducing costs, and also a big divestment plan. So this move to double down on oil and gas was widely anticipated by the street. Just to take a step back in 2020, BP was the first of the big oil companies to pledge net zero emissions by 2050. It set targets to cut oil and gas production while increasing renewable energy output by 2030. But that strategy really has come under increasing criticism from activist investors that have been really voicing their concerns that the renewable investments were destroying shareholder value. You had Elliott Management that entered the scene recently, amassing reportedly some 5% stake in the company. And with this move, now investments in renewables will be reduced by 70%. 100%, but some of their green businesses may be receiving partners. So on the divestment side of the business, Castor Oil, that's their lubricant business, which has been also involved in coolants for data centers. That's up for strategic review. They're also talking about perhaps a partner for Light Source, its solar units. But I do want to make one note that the rate of buybacks has been cut to anywhere between $750 million to $1 billion. That's a sizable cut, more than what analysts had been expecting. That's perhaps why you also may be seeing the stock down a bit today, because it has gotten sort of lost in, or it may take some attention away from some of the other announcements.
Yeah, no, it's this pivot that we're seeing from some of these companies, of course, coming at a time when we've seen crude under a bit of pressure. You have WTI, I believe, trading in the high 60s at this point. I'm curious what you're hearing about this steady move that we've seen to the downside.
Yeah, so as far as the steady move to the downside, look, they are going to be increasing production. And the production also has gotten now, for all of these companies, has gotten a lot more efficient. So the cost of producing oil, of drilling, has gotten much, much better. So even the break-even point, you've had some analysts that have been talking about the break-even point going lower because of these more efficient ways of producing. But for BP, this is going back to their roots. This is going back to something that they know how to do very well. The question is whether this will appease those activist investors, all these moves that have been taken. But they're saying, look, we think that given all together, that in the coming weeks, when they talk to their long-term shareholders, that they are going to be pleasantly surprised as they see everything come together, everything packaged together. Today, it's just been a lot to digest.
More broadly here on oil, I mean, you have decisions from OPEC, and OPEC putting more pressure internationally on continents like Africa to increase production here. So what is kind of the lay of the land on oil more broadly as we're looking at some of both the supply inputs and where the governing bodies are also trying to figure out it makes sense?
Yeah, so, and OPEC has been sort of tied at the hands with respect to their market share, because they really want to increase market share, but they understand that there is the risk of oversupply. And all the analysts that we've spoken to have forecast that prices will be lower this year compared to last year, and going into 2026 even lower. So we'll have to see how that shakes out with what OPEC decides to do, how OPEC, if they're able to regain any market share, because look, everyone wants to drill now. Everybody is going in on the drilling. U.S. is going big time on the drilling, but OPEC really wants to be able to increase market share, but the prices are trending lower.
Right, Ines, thanks so much. Well, that does it for Morning Brief, but keep it right here. We've got Catalyst coming up next, much more analysis on some of the biggest drivers of today's market action. We'll be right back.